Welcome to TradeSpoon. My name is Vlad Karpel. I'm CEO and founder of TradeSpoon, and I'd like to continue our discussion of advanced option trading. Let's take a look. Why does volatility rank or volatility change is important? For every trade, we provide a TradeSpoon recommendation. We have one trade a day. Or for any hedge that we do, we always look at implied volatility. What is the definition of implied volatility rank? First of all, implied volatility is the measure of uncertainty of underlying asset, or measure of how much the underlying stock will move. So if you look at the implied volatility today versus 52-week low, and divide it by the difference between 52-week high and 52-week low, as you see it on a screenshot here, you see that the implied volatility rank is 28%. So to be a successful trader, you have to study the IV charts and IV movements. It is very important that IV rank helps you in strike price selection. The higher the IV rank, the higher you have prices of the options, the more extrinsic value you have in underlying options. At TradeSpoon, we provide one trade recommendation a day, and sometimes the most common question is, do you sell bullish put spreads, for example, or do you buy debit call spreads? What do? When implied volatility is relatively low, that means options are relatively cheap. Then you buy options. When the implied volatility rank is high, greater than 50%, then you sell options. Unlike a lot of the services out there, we don't just always buy options, or we don't just always sell options. We study implied volatility of underlying assets, and when we get enough premium for the options, we sell premium. Whether we do iron condor that we discussed in our previous session, or we just do a credit call spread or credit put spreads, we do look at implied volatility. So the concept is simple. You look at the chart, 52-week chart of implied volatility that you can see in green color. If you're on the bottom of the chart and you see the troughs of the mountains, then you buy. This is when you buy options. When you see peaks of the mountains, high IV, you sell. So that's what determines whether you're doing a debit strategy or a credit strategy. Always keep in mind probability of success versus risk. High probability of success means high risk, low return on capital. It's great to do when the implied volatility rank is high. Low probability of success means you're taking low risk by high return on capital. This is great when options are cheap and implied volatility is low. That means you're buying options, you're buying debit spreads. As you get more comfortable with return on capital, you will start structuring your trades with higher probability of success and high implied volatility. You can find out more information if you visit our upcoming webinars, or you can follow us on social media. Thank you.